Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, September 25th. Appetite in Chinese technology stocks remains firm while major US indices stagnate near their all-time high levels into the upcoming US GDP and PCE updates of the next few hours and days that could help readjust the Fed expectations and give stocks, bonds and the US dollar a fresh direction. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So risk sentiment was limited yesterday across European and US indices as investors probably decided to take some of their profits in their pockets on the latest rally and walk away before the fresh data hits the ground. And on the other hand, on the policy side, another Fed member, Mary Daly, said yesterday that she would support further policy easing in the US, but still stressed that they should proceed cautiously to avoid oversteering. So comments came a day after the Fed President Jerome Powell himself didn't want to commit to further interest rate cuts in October, pointing at looming inflation risks. He also said that asset valuations look quite high, but it is not their mandate. It sure isn't, but lowering the interest rates while increasing growth forecasts help Jerome. But anyway, this week, the Fed comments are not necessarily supportive of the dovish Fed expectations, but AI and tech sector related news is, as Nvidia said, it would invest up to 100 billion US dollars in OpenAI, and OpenAI said that it would invest roughly 400 billion US dollars to develop 5 new data centers in the United States, suggesting that capital will continue to turn round and round and benefit to those companies who are actually inside this exclusive technology club. But somehow investors are looking somewhere else this week or not really feeling like buying more, even though the news are quite supportive of what's to come for AI and technology sector. Because Micron, for example, just delivered a blowout quarter with revenues and profits smashing market expectations on the back of insatiable AI demand and soaring margins in its cloud memory unit. Yet the stock fell nearly 3% yesterday's trading session as investors chose to cash in after a stellar run. The guidance was nothing short of bullish either, pointing to even stronger sales and profits ahead, with HBM capacity sold out well into 2026, reminding markets that Micron sits squarely at the heart of the AI supply chain. But as often happens in financial markets, good news wasn't quite enough, or good enough actually, to keep the rally going, raising the question among investors that after such a rapid climb, and we're talking about a 170% rally since April this year, well, investors are questioning, is Micron's story already priced in, or is this just a pose before the next leg higher? I guess time will tell. On the flip side of the world, investors are not yet ready to take their profit, however, because there's probably more to be made there. Alibaba yesterday ended up gaining more than 9% on its pledge to invest more in AI, and is again up this morning in Hong Kong, testing fresh highs since 2021. Bubble, cries some investors out there. The company trades with a PE ratio of around 26 right now versus Amazon's PE ratio of around 33, for example. So it's still cheaper than the USPs, but the gap is closing for sure. I still think that there is further room to run for this technology rally in China, also given the fact that the Chinese funds are also behind the latest rally in the Chinese technology markets and the Chinese markets altogether. But soon valuations there will be questioned as well. We are not there, but we are getting there. Now today, all eyes are on the latest US GDP update, which is a key pulse check for investors. So US growth is expected to have rebounded to 3.3% in the second quarter, following a bad disruption due to the trade war in the first quarter, remember, reinforcing the soft landing narrative for the US economy. But soft landing is a double-edged news right now. Because a stronger than expected GDP print could reignite concerns that the Federal Reserve may refrain from pushing the interest rates further down in the US, especially next year when the Federal Reserve members have very, very divergent opinions about what to do next with the US rates. And the latter could eventually push bond yields higher, lend support to the US dollar that has been smashed throughout this year while weighing on the equity valuations. Conversely, a softer than expected GDP read today from the US would likely bolster bets on further Fed easing, sending yields lower, lifting stock valuations, and taking some shine off the greenback again. In short, today's GDP print, combined with tomorrow's PCE and core PCE data, have the potential to set the tone across bonds, stocks, and currency markets after weeks of dovish shift in the Fed expectations, with still an unknown path for 2026. Now, inside the FX space, the US dollar rebounded yesterday, limiting gains in majors like the Eurodollar and cable near their psychological levels. The Eurodollar attracted solid offers above the 118 resistance, while cable couldn't protect its 135 support yesterday and is below this morning. As I had said last week already, following the Federal Reserve's decision and the dot plot, there is now a chance that we see a minor upside correction in the US dollar across the board, and that will be due to a readjustment in dovish Fed expectations that would get a little bit less dovish. And every piece of data hinting at resilient US growth, not too much weakness in the US jobs market, and heating price data should back that US dollar recovery narrative, even though the medium to long-term outlook for the US dollar remains unquestionably negative for now. And that is obviously due to the waning global appetite for the US debt, rising worries regarding the US dollar's status as the world's base currency, when the United States is now looking like it is actually pulling away from the world, both in terms of their military support and their trade and other collaborations. And I'm also talking about the visas here, yes. But anyway, that's a discussion for another day. In the shorter run, and elsewhere, it's not only the US debt that investors don't want, mind you, but the British gilts remain very, very much unloved as well among global investors. Indeed, this week's treasury auctions in the United Kingdom underscored growing investor unease over the UK's fiscal trajectory. Demand for the 30-year bond in the UK fell to its weakest level since 2022, while the 5-year sale of UK gilts was absorbed with the thinnest cushion in nearly 2 years. So the tepid appetite here highlights how high and rising budget concerns in the UK are beginning to weigh on longer-term government debt appetite, and the latter also weighs heavily on UK's growth projections at a time when inflation in the country remains quite threatening enough at least to keep the Bank of England's hands tied. As such, sterling looks unappetizing to me, both against the euro and the US dollar into the autumn budget announcement in the United Kingdom. Here in Switzerland, by the time this episode of Market Talk gets to you, the Swiss National Bank will have probably announced to have kept its monetary policy rate at 0%. Now, many people out there, including the SNB chair Martin Schlegel himself, think that a return to negative rates in Switzerland would be a step too far, probably given the current economic backdrop in the country and the franc's current stability. The franc, however, remains stable near its strongest levels in history against both the US dollar and the single currency. And the latter is suggesting that while the Swiss National Bank is expected to hold its rates above 0 throughout 2026, direct FX interventions from the SNB become increasingly likely if demand for the Swiss franc spikes again. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.